Hey, before we get started, I have some exciting news. The Wiser Roundtable podcast is going to be changing names. We're going to be moving to a new format, and we're going to change our name to a Wiser Retirement. We think that this reflects more what our topics are about week to week, and we are excited to start with a new quarterly theme, really about investing, which is something that we happen to be pretty good at around here. 3 ways to grow and protect your portfolio will be our focus for the first quarter of 2022. So thank you for listening. We get wonderful feedback from our listeners. Reach out to us anytime with maybe topics that you'd like to hear about, and we will see you in 2022 under the name A Wiser Retirement. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts today, Brad Lyons, Matthews Barnett, and Jordan Sute.
Hi, Casey.
Hi, Casey. How's it going?
So we got the gang back together. We've had a whole quarter of mix and match, and I think it's been good. Tax topics are difficult because unless you're paying a lot of it, you don't pay much attention to it. So it's been interesting to kind of work through these 10 important things to know about taxes. I will say to start off, thank you, Jordan, for joining us this quarter, and we will plan on having you back as many times as you want to make the drive over here.
Thanks for having me. I've had fun.
Good.
It's been fun.
Jordan is Sute CPA. You can find them at sutecpa.com. We have a long history of working very well together with Sute CPA, being able to easily pass information back and forth for common clients. And so it was a natural fit to add them to our tax podcast for this final quarter of the year. The other things have happened, I feel like, over the last at least 2 quarters. I mean, Matthews over here is having the best year of his life. You know, he got engaged, right? We just announced we have promoted him to no longer financial specialist, or financial planning specialist, but also financial planner. So he has his own support people now.
Been busy. It's been good. Thank you.
Yeah, and so it's been a good. I think it's been a good quarter. Wiser itself this year, we're recording this just prior to the end of the year, but growth rate is up over 62%. Year to date, and adding clients, and then our assets that we manage on behalf of clients. And, you know, we do track our hourly clients as well. And we have helped a record number of people on an hourly basis. So it has been a great 2021. It was even a great 2020, honestly. We had that little blip there at the beginning, obviously, but
well, that's the first I've heard it described as that little blip.
Yeah, that's true. That's true. Well, it was, though. You know, it's the thing about asset management is, man, it's so easy to freak out when the sky's falling, or you think the sky's falling. But in the end, when you look back, it's just this little tiny, it's almost like a little check mark in the graph, you know? It's hard to keep your cool, but we have a great team here, and we didn't have any clients that lost it over the COVID drop, thank goodness, and they're much more prosperous now because of it. So let's kind of dive into this. We've got, this is kind of our last podcast, obviously on tax. I mentioned that earlier, but also it's our last podcast as the Roundtable. We've tried something new in 2020. I said, hey, we should start a podcast and start talking about everything that we know and just throw it all out there. And we had to come up with a name, and no one could come up with a name. And they said, well, what's the podcast going to be about? I said, I don't know. We're just going to pick something that we think is relevant at the time, and we'll start talking about it. And that worked for a little while. We did the first 5 podcasts, I think, is just like our philosophies on things and how we think about investing. Those really haven't changed. But that theme kind of carried through the rest of the podcast as well. And so we came up with the Roundtable because we're literally sitting at a round table. And the idea is that, you know, it goes back to the boardroom, right? So if you have a long table, you have a head of the table, right? It's like Thanksgiving dinner, you know, dad's here, and then who's going to sit on the other head of the table, right? It's always oldest, I think. But This is in my family. At the round table, everyone has an equal voice. And so that's what we try to create through this process. But in reality, most of the stuff we talk about is retirement. And honestly, when you look at the downloads, that's what people want to hear. People want to hear things that are associated with being in retirement or getting ready for retirement. And so we're going to start shifting. Still, we'll have a diversified list of topics, but Hadley here, our marketing person, has done a great job of saying, hey, you guys can't just jump on over topic and topic. We need to keep to a theme each quarter. So we're going to roll into next year with a new theme and a new name. We are going to call the show a Wiser Retirement Podcast, kind of a play on our company name. And then on the Wiser Retirement Podcast, our first theme for the quarter is going to be focused on 3 ways to grow and protect your investments. And I'm excited about this. We don't have to do much prep for these topics because we have been ingrained, Brad for 30 years, myself for 21 years, Matthews for 15 years, on how to manage assets. Managing assets is the easy part of our business. I'd say the planning sometimes can be rather contentious, not because of the clients, but because of government changes and the rules. You know, the goalposts keep getting moved on certain items, so you're always chasing that. I tell clients a lot of times, 75% of our time is spent planning, 25% is spent, actually managing the assets. That's fairly straightforward. But anyway, I'm excited about that. Hope you guys are too. So let's kind of recap what we've done up to this point. We have how to find the right CPA. I struggle with that because we before we had Michael Sute and Jordan and David, I would hire CPAs to work in our office. And what I found is CPAs and attorneys that are solo, meaning they don't have any support people, they just work by themselves. There's a reason. It's because they don't work well with others. They don't communicate well. And it was so frustrating to be a firm like ours that communicates well, and then you refer your client literally to someone across the hall from you, and they can't return a phone call or email. That was frustrating.
Right. Yeah. We were doing a continuing education course yesterday, and there was a line in there that I thought was funny. CPAs don't get excited about I messed it up. I'm gonna have to start over. It was the funniest joke. Hold on.
That's hilarious.
Okay. No. It's
That's our first blooper.
That's right.
So yesterday we were doing a continuing education course, and there was a line that was pretty funny about CPAs, and it was that CPAs aren't dull people. They just get excited about dull things. And so I think taxes are a very dull thing, but you need to find somebody who is excited to learn and excited to continue growing and continue learning about all the changes that are happening literally every single year now.
I think it's also important, obviously, just to looking at CPAs, because we see a lot of clients that are managing it themselves just through random tax software. And, to some point, some complexity, that's fine. But eventually, it's not just about filing taxes, it's about proactively planning throughout the year. So that can really help individuals and families.
Right.
Then you have specialization as well, don't you, Jordan? Mm-hmm. Or certain CPAs, at least either at an individual level or a firm level, they're going to specialize in real estate transactions or commercial transactions or your basic, family, tax returns. And you want to find somebody who specializes in what your circumstance, is, right?
And a good CPA won't try to do it all. If they hear your circumstances and it doesn't fit what they do, they'll lead you to the right person. Mm-hmm.
Yeah, I think that comes down to like living abroad, paying foreign taxes, and living here in the U.S. I think I've sent a few of those you guys' way, and you're like, yeah, no.
Yeah.
And then we have, farmers. I mean, that's a whole different ballgame. People farm. So yeah. Those they're definitely different specialties. Just like there's different doctors that do different things, right?
Mm-hmm. Yeah, exactly.
All right, number 2, donor advised fund benefits. It's not too late. Well, it's probably too late now to create a donor advised fund for 2021 and fund it and getting all that done. But hey, there's always next year if you haven't done it already. But what a great way to be able to save on taxes immediately and then take your time in how you want to disperse funds, or even allow a fund to build. So maybe it's just the income that's gifted every year, and you're leaving a consistent legacy going forward.
You know what it's not too late for, kind of piggybacking off the charitable donations, it's not too late to stack your donations. So maybe you're not, using a donor advised fund, but you regularly give to your church or your charity of choice. And maybe you're not hitting that itemized deduction limit every year, but you would if maybe you did 2 years in one. So instead of, writing a big check in January and a big check in December, maybe you write 2 checks in December, and it allows you to get over that hump of the itemized deductions for the year, and thus you get the benefit, and your charity's still getting the kind of drawn out benefit. You're not hurting them in any way, but you're also helping yourself.
I think that's one of the benefits of having a CPA looking over your taxes versus using some of the software that's out there.
It's just not common. You think that they double the standard deduction, so people just assume that they can take that, and it doesn't make any sense to give to charity. But there are options out there, like you said,
right,
with the bunching of donations or a donor advised fund in the future.
Yeah.
Tax credits that help the community. We had a lot of fun with this. We had a couple of guests come in talking specifically about Georgia Goal. I pay a lot of state tax, and for me, it's nice to know that it's just not going to the general fund, and that I can direct exactly where I want it to go. So I was able to put $10,000 into my kid's school to go toward people who maybe it's a stretch for them to go to their school. And so now that's a $10,000 scholarship that gets used right away. It's not sitting there in an endowment or anything. We also talked about the hospital credit. Mm-hmm. Rural hospital credit. No, we're not really in a rural area here, but Wellstar has Sylvan Grove that's been it's actually closed out. It received its max for this year.
And I think they'd reached their cap from like a Georgia revenue standpoint, but I don't believe Goal had when we had done the episode. So there's still a chance to take advantage of the Goal credit for 2021.
Correct.
And I think that was probably one of my favorite episodes, was hearing about the impacts that those tax credits have, especially on the schools. It's amazing, the impact that you can have with your tax dollars.
Number 4 was moving to a tax-friendly state. I don't know, moving sounds horrible to me. But I guess if someone could convince me it was advantageous to move a business to a different state and it'd save thousands of dollars in taxes, maybe that'd make me perk up. But there's too many boxes in my basement. I don't know about that.
Well, the thing about looking at moving to a tax-friendly state, I mean, every state has its budget and every state has its citizens and its needs, and they have to raise that money somehow. Some of them do it just with state income tax, and some do it without a state income tax. But if they're doing it without a state income tax, they're raising taxes elsewhere. They're raising revenue elsewhere. And so as you consider, moving to a more tax-friendly state, one that may not have a state income tax, although that makes the headline, right? 0 state income tax. It may be that their local tax is high. It may be that their retail tax is high. It may be that their gas tax is high, etc. So all these things can be calculated and figured in when making this decision to move to another location. The primary should be that that's where you want to live.
Unless you live in like Manhattan, then any place is cheaper.
California.
If you live in Manhattan, you probably aren't thinking about it too much.
I don't know. It seems like a lot of people are coming out of there. But even in Georgia, was it age 65 and below 80,000? You don't pay state tax?
Yes, that's correct. You get 40 apiece. Mm-hmm.
Yeah. Mm-hmm. Okay. So I always joke with that. I always like say that's how we compete with Florida, so we don't lose all our old people to Florida.
And I think that episode we also talked about, all right, what if you have to move? What do you do when you have to move? Like, how do you sever ties with, your state? And we talked about it kind of being like a breakup. You have to take some steps to make sure that one state, say Manhattan, can't come back in and claw your income back into their state. So just as important as considering which state to live in is making sure if you have to move, you're taking the right steps.
If you're going to break up, you got to break up the right way.
Yeah.
Hard cut.
Yeah. Cut all the ties.
Yes.
Yes.
I was surprised by that, but actually it makes sense. I mean, I think that episode was really, the theme of that was probably more like, don't cheat the system.
Right.
Don't try to cheat the system.
Right.
I mean, if you're really moving, why wouldn't you be registering to vote and changing your car and changing your bank statements and everything? Why? The only other way I could see it is if you kept a home in the prior state, that creates a lot of gray area. So you have to be very careful that you really did move. I still like your story about the guy getting audited, and the only reason the IRS left him alone was, or the Department of Revenue for the state, I guess, left him alone was because he took his dog with him. It's like, if you took your dog, then you definitely moved.
Of course you moved, duh.
Of course you moved. Didn't matter about the car or the registration, but you took your dog.
Yeah.
That dog paid for itself.
It did, yep.
Maximize retirement savings. So we had fun with that episode, talking a lot about how investing money into your 401k is a great way to save on taxes. And for a lot of people, that's almost all they have is pre-tax savings.
Pre-tax savings, 401ks, we mentioned before. If not, with IRAs in Georgia, you can get a slight deduction, 529 plans. And also, often overlooked one that we discussed was health savings accounts. A lot of times people don't understand exactly how those work, that they can get the deduction, it grows tax-free, and that they can use those for qualified health expenses. So those are also a nice added benefit with HSAs as well.
We had a couple in here, I guess this last week, both worked for companies that didn't offer 401k plans. We don't see that very often, but it's probably pretty common. There's a lot of businesses that don't offer 401k plans. You can still put money into an IRA no matter what your income is if you don't have access to a 401k plan.
Right. It's a sizable commitment by a company to offer a 401k. There's a cost associated with it. Then there's an audit associated with it. There's some paperwork. So, look, there's a lot that just don't want to do it.
Like, I'm a business owner. I don't get it. Well, why wouldn't you offer at least a simple IRA to your employees? You can do a simple IRA. It has no admin costs. You have to match 3% of their income, and it's a little dangerous. They can literally go invest whenever they want to inside a brokerage account, but you can put some parameters around it if you work with an advisor. But it doesn't cost you anything. And then a safe harbor 401k plan. Go create a safe harbor 401k plan. Now, that could cost you $400 a month. So there's some added costs. If you got a new startup company, that could be real money. But, man.
It's a good way to attain the right employees that you're looking for, obviously, with benefits like health insurance and certain
it is.
Retirement plans. I mean, you mentioned IRAs could be the option outside of that. But you can only put in $6,000 into an IRA or $7,000 if over 50. That's significantly less than $20,500, which you could do next year.
But at least with the simple, there's that 3% match. You can put in $13,500 if you're under 50.
Still twice as much.
And I guess, we've had some younger businesses with very young business owners come through and over the years, and what they say is, my employees aren't asking for this. And it's like, yeah, but it's like children. They don't ask to go to school. You just send them.
Right.
Right. And so I'm like, these people are here to take care of you. Why aren't you taking care of them? And that just bothers me. And then you've got ones that say, I offer a 401k plan. They could start pounding their chest, and it's like an insurance based one, or it's mutual fund based, like it's American Funds, whoever. And they're literally getting charged 4.25% commission for every dollar that goes into the account. And I shake my head about that too. And obviously, you can't. Not everyone can be an expert about this like we are. Mm-hmm. But it's almost. It's like I just get angry at the regulators. It's like, why would you even allow that to happen? That people lose 4.25% for every dollar they put into their 401k plan. It's crazy. But anyway, there's an easy fix, and there are so many startups right now out there in the 401k space that are offering very low cost 401k plans for your company, and but at the minimum, do a simple. We've had clients start with simple IRAs, and they kind of graduated to a 401k after they saw how well it was working. You can do it payroll deduct. ADP software will calculate how much is supposed to go into that simple IRA, and it'll automatically send a check to the custodian. So it can be very automated to where the business owner doesn't really have to think about it. Tax strategies to avoid and how to negotiate with the IRS. Don't be Wesley Snipes. People get really scared of this IRS letters, and I get it. But if you're preparing taxes and you had a good year, but you're still cash poor, hey, maybe something really good happened. You paid off all your debt, and then now, but you forgot about the IRS at the end of the year.
Right.
they're very easy to work with. If you owe less than $50,000, you don't even have to talk to anybody on the phone. You just go online and pick out your own payment plan. It gets approved. They'll auto deduct it from your checking account. Hopefully you can get out from under it in a few months, but maybe it takes a couple of years. The worst thing you can do is stick your head in the sand.
Yeah, don't do that.
And do nothing.
Correct.
That's when you find out there's other people who want to come on up to your house and put liens on it.
And it's always important, just even if you are behind to file on time, because, I mean, the penalties for failure to file, failure to pay isn't too awful, but the failure to file penalty can really start to stack up and just can be really detrimental to some people. So even if you're falling behind, just try to file every time or every year on time, file that extension, give yourself as much time as possible. Definitely recommend that to help keep yourself above water a little bit. I also liked on that episode, we talked about the scams to avoid, like the dirty dozen, I think we went through.
Right.
Which I learned about some things in that episode that scammers are out there doing. That's just wild. So I think the key takeaway from that was don't answer the phone and talk to the IRS because they're not calling.
Yeah.
It's not them.
That's right.
Not
that's
them.
Right. Yeah. There's some crazy things that have happened. Everything we talked about, obviously, in that section. Utilize tax loss harvesting. So that's something that I don't think do-it-yourself investors do very well, and it's something that some brokers don't do very well. But most firms, independent firms, should be doing this very well because there's software that helps you figure this stuff out. But basically, you have gains and losses. And you have opportunities throughout the year to be able to sell those losses, move into something similar, but not the same as the security that you had. And you can write off up to $3,000 a year net. So if you had a $50,000 loss and a $47,000 gain, you could write off $3,000 in the end. Mm-hmm. And if you don't write it off in that one year, you can carry it forward.
Correct.
So, Brad, you're the king of that around here.
Well, it has an added benefit of you're adding return on an after-tax basis to your overall portfolio. So by utilizing the opportunities that exist, now nobody wants to see losses in their portfolio, but when they do occur, let's take advantage of it. Let's sell off those securities. Let's buy, for a short period of 30 days, a similar security, but not exactly like security. Utilize the tax loss harvesting methodology. Go back into the original security if you still like it, due to it's just gone through a short-term depressed price period, and then write it off your taxes. Take advantage of the tax bill. And so we find that by doing this, you're able to increase the net after-tax return of a portfolio.
And individual investors have a hard time with that. Not because they necessarily don't know how, but they're emotionally attached to the stocks. Their fear is they're going to sell it and then it's going to go up.
Well, keep in mind, as an individual investor, they picked that stock.
Right, yes.
Whatever due diligence they did, and they picked that stock. And now to sell it is to recognize that, well, maybe it wasn't the best idea they had that day. And that's difficult, so I can't blame them, but they're missing out on an opportunity that is provided to them through the IRS tax code. They should take advantage of it.
That's why I like index funds so much better than individual securities. Now, I understand that there's a Tesla and the Google out there, but there's also Enron and other scary stuff, and companies that are supposed to do great, like Amazon. And it's been kind of flat this last year relative to the overall market.
Right.
But you buy the index fund like S&P 500, and you have a COVID crash, you're down 30%. Then you sell it. And you buy Vanguard Large Cap Fund, which is very, very similar, right? And you just created a $30,000 loss, right? It's nothing personal, and you're buying the stocks right back, just in a slightly different formula on the other side. Right?
Yeah, it's not like you're getting out of the market. You're buying something
yes.
very similar, and then you can always, after 30 days, go back and buy the same fund. So it's just a good way to help reduce some taxes to your advantage when the market does drop.
That's a good point, Matthews. It is not market timing at all.
Right.
There's nothing. You're out of the market for maybe a millisecond. That's about it. If you do it right.
Because you're using the proceeds to buy back that similar security immediately. And in today's world where transaction costs are zero on a lot of brokerage platforms, it becomes a net position in your portfolio.
Right. Podcasts are the number 8 was S Corp, C Corp, LLC tax differences. That was a bit of a head spinner.
It was. There was a lot going on in that episode.
Choose carefully.
Yes, agreed.
I mean, I don't know why anybody would start off as a C, but I mean, most people should probably just be S Corps,
right?
In my mind, is what we got out of all that. We tell people, put properties into LLCs, create some, cheat protection from liability, but I wouldn't say that we're the first stop for, do I do an SC or an LLC? Probably a lot of businesses start with LLC and they kind of grow into S Corp, I think is how it ends up being. But that was interesting to prepare for. Number 9, tax deductions for business owners. So tax deductions that people are missing. I get this question all the time. We have a lot of business owner clients here, and it's like, hey, what am I missing on my taxes? They think like there's some magic sitting out there that, no one's paying taxes except me. And that's, hey, if you're profitable and you have a tax problem, that's good.
Right.
That's actually that's a good problem to have. But there are some basic things that we covered on that list that probably a lot of people are missing. One that I like to tell is meetings, your annual meeting. I don't know if we covered it in that podcast.
I don't think we did.
This is a bonus.
There we go.
So if you own your business, you are supposed to be having an annual meeting where you update your minutes and you do shareholder type decisions, right? So first of all, most business owners don't do that. They should be, because that's the easiest way to pierce the corporate veil, is to say, if there's a lawsuit, hey, this is not really a business. This is just them operating under a different name, because look, they don't even have minutes and they keep all their personal stuff is inside the checking account. We did cover that. I do remember that. But you can have a travel day covered as an expense. You can have a meeting day and another travel day at a minimum. You might be able to get with 2 days in the middle. So if your wife's also a shareholder in the company, then why not have a shareholder meeting, go to Tahiti, you get 2 days to travel that far.
Yep.
You get 1 day you can deduct there, and then might be able to get away with 2. And then 2 days to travel back home. And you can cover the airfare, and you can cover at least 1 or 2 nights. So maybe Tahiti's a little extreme.
Yeah.
But Florida.
It's funny you say that, because I was doing a return this past season, and they have a rental. They have rental properties. A couple.
Oh yeah, this is 1 trip per entity. Yeah.
Yes, and I stumbled across their minutes that they had from their Destin beach vacation, and it was probably a little drawn out of a meeting, over a 4-day vacation to discuss
Right.
2 rental properties, but I appreciated the effort for sure. Yeah.
Yeah, 4 days, a little much.
A little much. Yeah.
Unless it's a really big company, then maybe you could argue with lots of shareholders. But then it's not a family vacation anymore. It's just work.
Exactly. Right.
Yeah, I think people miss that one. But yeah, you get 1 per entity, right?
Yeah.
So if you have a vacation home, it's in a rental program, that's an LLC.
Yeah.
That's an annual meeting.
Yeah, and you got to be reasonable about it, but there is the opportunity. Yeah.
Oh yeah. Definitely
Sure.
reasonable.
Yes. Not 4 days.
No, probably not. Okay. 1031 exchange. So this is something that a lot of people just don't know that much about. And
Right.
the 1031 exchange, basically, you sell an investment property, you have all these gains. You're going to pay capital gains tax on that. Where if you have another property selected, either beforehand or within, I think, 45 days, then you have the ability to take your capital gains and roll it into the new property.
Yeah.
So you don't have that tax. So you just keep rolling that through.
Right.
And then there's all these nuances, which we covered in that episode.
Yeah. I think it's just something, if you have investment properties, it's something to know about before you're thinking about selling, because we have so many people call the day before closing and they're like, how do I defer this tax? And we're like, oh,
It's too late.
It's a little too late.
You
Yeah.
almost have to do it when during the contract phase. You know, when you're getting an agreement. I think that's where you have to start doing that.
Yeah. I mean, you really should be thinking about it even before you sell, you know, and then, engaging in that during the contract period for sure.
Right. Because you have to have the intermediary that's going to hold the assets, and you have to have the property that you're looking into. So it's definitely a process that's not last minute.
Yeah.
Well, I hope all our listeners were able to draw something out of the 10 important things to know about taxes. We are putting this one in the vault, seal it away, and we're going to come out on the other side as a wiser retirement podcast with me, Brad, and Matthews, and Jordan, as much as she'll make the drive. And it's been fun. Happy New Year, and I'll see you guys on the other side.
Thank you.
Thank you.
Sounds great.
Thanks for listening to the Wiser Roundtable podcast. We hope you enjoyed it. Make sure to subscribe wherever you're listening. That way you don't miss out on new episodes. Head to wiserinvestor.com and reach out if you have any questions. We would love to hear from you. Today's episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.